And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread. And today we're going to deal with a time-old concept. This concept has been around forever, like literally forever, if you've ever dealt with the investing world. And it's applicable to a number of different strategies. Now, we're going to talk specifically about securities today, but you could actually deal with this concept across maybe buying businesses, maybe buying real estate. You could deal with this concept of buying baseball cards even if you wanted to, or Legos. I mean, it doesn't matter what you're investing in. This concept works across almost every particular investment vehicle out there. So I'm joined by my dear friend and colleague, Mr. Jeff Jetter. How are you today, brother?
I'm very good. Thank you very much. I understand we're both on Happy Shirt Friday.
It is Happy Shirt Friday. I am wearing a tablecloth.
Agreed.
Agreed. Jerk.
And I'm wearing my blue Hawaiian shirt because it's summertime and everything's starting to open up. We're looking forward to getting back to the pools and the splash countries and all that kind of stuff.
I hear you, buddy. I'm right there with you on that. I'm so ready for life to get back to normal. You know, it's been kind of a mild summer thus far, though, here in East Tennessee, hasn't it? I mean, here we are mid-June, late June almost. And dude, I was like bundled up in a blanket last week in the hammock. It's crazy, huh?
Felt great.
Felt great. Well, I was talking to one of my buddies. He goes, dude, this is like fat boy weather. Man, he goes, I don't have to sweat in this weather. So I got to ask you a question. What's your favorite song?
My favorite what?
Your favorite song. What is your favorite song to listen to?
It'd probably be Red Letters by Crowder.
Really?
Yeah.
Really? That's a cool song. That's a cool song.
Now that it changes often, but right now I'm sort of into Crowder, and I'm enjoying that.
Crowder often comes here to East Tennessee and performs at Dollywood here in East Tennessee and some other locations.
Seen him several times.
Yeah, he throws a heck of a show on, doesn't he?
He does.
Yeah. So our timeless strategy that we're going to be dealing with today, Jeff, is dollar cost averaging. Now, I got to tell you, I've been in the financial world 18 years, 2003, so however long that's 17 years almost. Yeah. Whenever I first heard this was long before I ever entered the financial world. I actually heard this when I was a teenager reading an old Larry Burkett and Dave Ramsey book. Okay. One of Dave Ramsey's very first books came out when I was in my late teens, early 20s. And Larry Burkett was the founder of Crown Ministries, I believe it was. And he was dealing with this concept of dollar cost averaging. Today, I want to deal with the subject, Jeff, and your expertise as a CFP, a certified financial planner, the director of financial planning here within the Heritage family. I mean, you're dealing with this nonstop, but I want to spin it in the light of a business owner. You know, we business owners, we look at our business as our number one asset. I mean, you and I have seen this real hand through the financial plans that your department cranks out. We can show mathematically that a properly designed business can help a client potentially, not always, but potentially double their net worth every 3 to 5 years by driving that value of that company up. Mm-hmm. But one of the things that we have to deal with as business owners is oftentimes being the business as a larger asset, we're trying to diversify cash flow. They have a good month. We want to put some money out of the business over here into a side account, whether it's like a Roth IRA, a 401k, an IRA. You know, we want to set up a strategy. Now, on the blog, I've dealt with this concept of a moose. You know, not the animal with the big crazy horns on its head. I deal with it called a monthly out of sight expense. And there was a book that I read every year. As I'm kind of laying the groundwork here for dollar cost averaging, there's a book I read every year called The Richest Man in Babylon. And in that book, the thesis of the book is to pay yourself first. So we have business owners who we've trained to pay themselves first because they may not be able to sell their business. We train them and they know that their business is their highest prized asset and they want it to grow. But now they're getting some extra cash because they're investing in their business, and we're diverting that cash out of their business into their various types of tax advantage accounts or non-qualified accounts. And then we try to do it on a monthly basis so it's out of sight, out of mind, and they're paying themselves first, and enters onto the stage this concept of dollar cost averaging. So here we are with the groundwork. Jeff, in simple terms, what is dollar cost averaging?
All right. Well, in the simplest of terms, dollar cost averaging is what we're trying to do is take our investment dollars, break them up into timely investments where we're not concerned or we're not trying to chase or time a market. We're trying any market for that matter. We're trying to invest a regular or set figure, set asset amount In the long run, we find that those assets tend to accumulate more of whatever that asset may be.
Okay,
It
so
may be
let
stocks
me
and
tear that
bonds.
apart a little bit before we go any further. Okay.
Yeah, let me take it to the simplest example. You said something about let's say we have a $10 sweet treat budget each month. Well, isn't it better when we can buy our sweet treats on sale?
Absolutely.
We get more sweet treats that month, right? And then next month, the price of sweet treats might go up a little. We don't get quite as many. But over the year, we have found that we're going to get a lot more sweet treats for our investment if we do it that way.
So we're going to dig into the math today, friends, on this and kind of explain how it works. But before we jump in that, Jeff, we often see dollar cost averaging most utilized in retirement savings, specifically maybe through an employer sponsored plan like a 401k or a simple or a SEP or something of that nature. And what we typically see is that whenever people get paid, we set our accounts up to where a little portion of that money, 3, 4, 5, 6, 10%, whatever the number is withdrawn from our paycheck and deposited into our retirement, our company sponsored retirement plan. With that being said, is there a right or wrong way on the frequency of deposits? So in other words, should it always be monthly? Should it always be weekly? Should it always be, daily even? What is the frequency and what should the frequency be when it comes to dollar cost averaging?
Well, in theory, the higher the frequency, the better the dollar cost averaging numbers. More realistically, the frequency should be kind of like what you had mentioned, that out of sight money. Let's do it when we get that disbursement, that paycheck, that distribution, whatever we have ourselves set up for that income or compensation, then let's go ahead and set it up then. One, it's out of sight. So we're encouraging fiscal discipline there, which has nothing to do with the concept of dollar cost averaging, but it certainly encourages that discipline. But the more frequently we can do that, the better the overall return. And the reason for that is we're taking advantage of fluctuation or volatility in whatever market it is.
So whenever we're dealing with dollar cost averaging, the opposite would be taking a lump sum at one single time and buying a lump sum purchase. We often see that on like a house, for example. But we've even seen when people like inherit money or they sell their business, they end up with this lump sum of money and they turn around and try to deploy it in the market all at one time. That is not dollar cost averaging. What we're seeing is you're taking, oftentimes for today's purposes, you're taking a fixed amount of money and you're purchasing let's say for simplicity, a fixed number of shares systematically. So it may be we're going to take $1,000 a month and buy this one particular investment every month for 2 or 3 years. Is that the simplest method to analyze this on?
And that's the essence of it. And in fact, even if you have that opportunity for that one-time investment, if you going back to your premise, it's always better to buy low and sell high, right?
Absolutely.
But we never know what tomorrow is or when we want to sell, what that market price will be. We don't know that fixed amount. We're hoping it will increase, but we don't want to take everything and throw that in now. It may be down, right? So what we want to do is we want to spread that investment out. When we have that out of sight money that you're talking about, that monthly investment of $1,000, then that's the perfect way to take advantage of dollar cost averaging.
One of the questions that came up during this COVID downturn that we've had this year, 2020, as we're recording this late in June of 2020, we saw the market take a 35, 36, 40, 50%, depending on which index you want to track, drop in about 3.5, 4, 5 weeks, depending on which index you're tracking. And we had clients who before then in January and February said, hey, I got a ton of money because of XYZ. Let me go ahead and invest. We're like, why don't we spread that out on a monthly contribution or weekly contribution over a period of time, and it ended up working in their favor. On the opposite side, we had those individuals who were calling saying, man, guys, the market's way down. Yeah, it could go a lot further, but I want to dump it all in at one time. And what we ended up saying the same thing, yeah, it could go down a lot further. Why don't we take and break that deposit up over a period of 2 or 3 or 4 weeks, months, years, even depending on the size of the investment and their particular client need. and basically just stream that fixed amount into the market. Ultimately, though, what we're doing is we're able to purchase more shares or more positions, ice cream treats, whatever it is. We're able to purchase more of those at a lower price point. That's kind of the result of dollar cost averaging, right?
It is. And it forces us to do what is academically correct or academically but counterintuitive to our emotions. So let's take our portfolio, our overall portfolio. Let's say we have $100,000 in our portfolio and the market takes a little dip, as some of us may have experienced this year, right? So it takes a little dip. What do we want to do? We want to hold on to our money, right? We don't, but wouldn't that be the time to actually put some money in? Maybe put $1,000 in. You put $1,000 into your retirement. I have often said this over the last few months. Retirement was on sale over the last few months, right? We had that dip in the market. So wouldn't it be a great time to put a little money in and buy that while it's on sale? If we were set up for this regular $1,000 investment over the end of March, April, May, we would have gotten more shares of retirement for that $1,000. And as we come into a recovery and growth, we're going to end up having more retirement available, if you think of it that way.
So let's illustrate this with some math. So Jeff and I are looking at some cheat sheets in front of us, friends. I'm going to challenge you that it's hard to often follow math on a blog, on a video, and we're going to send you, on a podcast, not a blog. We're going to actually upload this math onto our blog, found it Financially Simple, and perhaps even in the show notes here beneath the podcast or the YouTube channel video. But what we're looking at here is a simple mathematical equation that basically illustrates two premises. So Jeff, can you orally walk us through this math, and I'll try to bring it down to the simple as you go through this.
Yeah, I'll see what I can do. Considering that we have primarily a listening audience, it's hard to follow numbers. But basically what we're looking at is if you take a fixed dollar amount and the shares or the price per share fluctuates up and down in a volatile market, which, my goodness, we've seen that over the last 4 months, right? I mean, incredible fluctuations. So what we're seeing is that if we pick that date and we just invest that specific dollar amount each date, every now and then, we're going to catch it when it's on sale. Every now and then, we're going to catch it when it's manufacturer suggested retail price, right? Yeah. And every now and then, we may even end up paying a little more because we need it that month, right? But we want to make those regular investments. There is a calculation for this, and it's got a lot of fancy terms in it, but basically you take the number of periods. So we could do a 6-month period, a 12-month evaluation, a 52-week evaluation, depending how you get paid or how you make these investments. But you take those number of periods and you divide it by, here's where it gets tough, the sum of 1 divided by the price of each of those. So let's say we were doing 3 of them because I don't want to go into 52 weeks, right? And we've got our prices per share are $10, $11, and $10 again. We would do 1 divided by 10, 1 divided by 11, 1 divided by 10, add those together, and that would be the divisor of 3. So with 3 divided by whatever that calculation turned out to be.
And that gives you an average number, correct? That ends up being the average.
Well, it turns out typically it's not the average. If you take the average price per share over that period on those days, depending on the fluctuation, but if you have an increasing market, the average price of the price per share is almost always higher than your dollar cost averaging amount. And here's the reason. Here's the magic of all that math that I couldn't even follow. But the magic of all that is because you bought more shares when it was at a discount or on sale, you ended up at the end with more shares for the same dollar amount invested. So that's what you take and divide by how much you put in. So if it was $10 every month, and we did that for 6 months, we take however many shares divided by 60. That's our price per share.
Yeah. So what Jeff's describing there is the difference between the mathematical average. And so we get average by using his number. 10 plus 11 plus 10 is 31. Divided by 3 is going to be just over $10, like $10 and some odd change. That's an average. We were taught to do that in grade school. The difference being is when you divide it by the number of shares, that actually brings in what's called a harmonic mean, or harmonic mean. That's the technical term for this. At the end of the day, friends, here's the deal. By dollar cost averaging, you're able to get more shares or more positions, more stocks, ETFs, real estate, gold, Legos, even whatever it is you're fancy.
Sweet treats.
Sweet
right?
treats. Heck yeah, man. Some ice cream. Whatever it is you're after, you're able to get more of it for less price because you're buying. The price point is allowing you to buy more shares when it's down and less shares when it's up. So that's called a harmonic mean. So most people don't realize the power of dollar cost averaging, Jeff. What happens is you just illustrated that over 3 periods. But brother, when you start pushing that over 10 years, 20 years, 30 years, even as some of our younger business clients are dealing with, dude, they have significantly impacted their net worth and their long-term financial position by this simple age-old position called dollar cost averaging. Am I correct?
You are. And the math almost always works out here. We can run that for a long period of time and run the math. The DCA always works. But I also want to point out the other important aspects of dollar cost averaging. That is that money out of sight, right? So we've already made that commitment. We don't have to think about it. Sort of fire and forget, we used to say in the military. You got a missile that's already locked on. You can fire, you can make your maneuvers, and you can fire and forget that. The other thing is it encourages, almost mandates us to invest when things are at a discount, which sometimes feels wrong. Our portfolio took a little dip. Man, I want to hold that money. But if I have that $1,000 coming out automatically, I'm buying a lot more shares at a much better price.
I want to, before you go to your next point there, Jeff, I want to kind of hone in on that because I've gone through now 3 recessions, 3 major market movements in my investing life. Okay. 2 of which I was a professional advisor, CFP, that was managing millions and millions of dollars for other people 2 times now in that area. 1 time was just my own money. And inevitably, even with the COVID situation that we dealt with this year, brother, whenever the market fell, even mentally, the most astute people, I'm talking about CFOs, retired CFOs of publicly traded companies, CPA, CFOs, smart mathematical minds, did not buy when it was low. They wanted to get better before they bought. So I love the fact that dollar cost averaging puts us all on the same playing field. It actually puts those who DCA systematically over time at an advantage because you're pulling your mind and you're doing the opposite of what we have to do in investing. You know, I often say and whenever we're dealing with clients, you've heard me say this, that when we're dealing with investing, we have to think opposite of reality. So if I want to lose weight, what do? We diet and exercise, right? 2 different things. Man, and many times though, when it comes to the world of investing, if you want to do something, if you want to make more money, you do nothing. Right? Even the great oracle, Warren Buffett, that Chris Stewart and I were just talking about here in our last podcast about the Oracle of Omaha. Warren Buffett uses a statement that says our investing should border on lethargic, slothfulness in nature. Well, dollar cost averaging allows us to do that because we set it, as you said, fire, using your old Apache Pilot days, fire and forget. It actually allows us to set it and forget. So I don't want to skim over that discipline, brother. That is paramount. Besides getting the average value higher and creating financial discipline, are there any other advantages to dollar cost averaging?
Well, those are certainly the 2 biggest. The other one is you've got that continued investment and continued growth, that methodical, almost slothful, like you said, growth. It's going to grow. It's going to grow if you're always putting money in. The other thing is if you're always contributing to it with that out of sight money or that continuous investment, when we are in a dip, we don't feel it as much.
Yeah.
I want to take just another step back. And the reason so many smart minds
Yeah.
I'd like to lump myself in there, but anyway, those of us who talk about finances all the time, the reason we sort of tighten up a little when we're in a dip like that is emotion often drives that. And emotion drives our spending habits more than it does most of our other habits. You reach into your pocket to pull out $1. It's usually emotion. Emotion is driving that. You're buying something that tastes good, feels good, or something you want, right? So oftentimes when our emotions are in a low, like our portfolio took a dip, it's like, oh, I don't want to spend that $1. That's the time to put it in. You're going to get the best value for your buck.
So let's add some practicality to this and let's bring this plane to the ground. So
Okay.
Practicality, the most common use of dollar cost averaging has to be retirement savings. Would you agree with that?
I would certainly agree with that.
Okay. So when we're talking about retirement savings, we're talking about 401k, SEP, simple things of that nature. If you're self-employed, you probably have a simple 401k or SEP or something of that nature, putting some dollars back. And oftentimes our smart, as they say, business owners, they want to lump it in all at one time. And I'm of the position that dollar cost averaging ends up providing you the better return almost always. Now, occasionally you can hit timing right. I don't like that idea, but occasionally you can get lucky. But I like the idea of dollar cost averaging. Jeff, I got to tell you something I personally do. Okay, this is me personally. So you've seen my finances. I have a 401k that I participate in. I have Roth IRAs that I max out every year, at least try to, depending on income status. I have HSAs that I max out. I mean, Emily and I, as you've seen, we do our job to prepare for the future. Another thing that I often use, and in fact I use it on a regular basis, is this little app called Acorns. And so it in effect is a little funky dollar cost averaging, but it's a fun concept that I'm able to teach even my kids how it works. So what I do is every time I go to the gas pump, I did it this morning, I put gas in the old white truck out there. So I went and it was like $63. And that's actually not as bad because gas prices are down, but I put like $63.01 in my truck. And so then that program automatically rounds it up to $64. So it takes 99 cents out of my account today and it saves it for me. So every day it's pulling money out of my account. Now it's varying amounts, it's not the same, but it's pulling money out every single day and setting aside into a short-term savings account for me. That in effect is dollar cost averaging because I'm buying some investments with that particular movement. Now, I don't recommend that to be my primary investment portfolio. That by no means it's my short-term savings, but outside of the 401k, outside of maybe something like I just talked about with like a little app that you can use for like some Christmas money or something of that nature, are there any other ways that we could apply dollar cost averaging in our business lives, in our retirement planning lives as we're in retirement? Are there other ways you can think of that we can have some application to this strategy?
I'll tell you one of the best strategies I encourage, whether it be my young families just starting out in a new savings plan, and I'm encouraging them to invest a little bit in their 401k, or whether it's those folks getting near retirement or even into retirement, and we're trying to manage that. Whenever we have an increase in income, consider taking a good bit of that, maybe half, and making that disappear into your future. So what I'm getting at there is, let's say we get a 10% pay raise this year. Wouldn't that be nice, right? We get a 10% pay raise. Well, at the end of the year, take 5% and throw that into your 401k, or talk to your advisor, maybe a Roth IRA, an HSA, maybe whatever it is, but take 5% of your 50% of your pay raise, 5% of your new salary, and put that towards your future. You didn't see it anyway. And then take the other half and increase your lifestyle. Go live a little with what you've earned, but put a little bit of that away. That's dollar cost averaging too, because now every month that 50% of that 5% or your 2.5% increase is now going to go into that DCA machine.
Buddy, that's awesome sage wisdom. So we've talked about dollar cost averaging and how it affects us. We talked about dollar cost averaging and how we can actually build wealth faster or more appropriate and more solid mathematically. We talked about a couple of concepts here. So friends, look, if you're a business owner and you're like, holy Batman, I never considered this, or holy Batman, I want to take a lump sum all at one time. Hey, look, talk to your planner. Talk to your planner about how dollar cost averaging works in your world. I really firmly believe in monthly out-of-sight expenses. I can tell you I've seen it build my net worth significantly. Jeff sees it in his world, his personal life. We also see it with the literally hundreds of clients that we have the honor and privilege to serve on an annual basis here through the firm. Dollar cost averaging is a simple concept that so many miss, so many miss. Jeff's going to continue to join us on the podcast here talking about these simple financial planning concepts that oftentimes we smart people, you know who I'm talking about, me and you, friends, us business owners who know a lot, we just overlook them because we feel like it's not that big a deal. Kind of like diet and exercise, really want to know. So it's kind of like that. We just overlook the simple things of life. So look, friends, from Jeff and Justin here, I want to tell you that life is hard. Life is hard, but life is good. Life is good. Red Letters. If you've never heard this song by Crowder, you ought to listen to it. It's a cool song, especially watch the video on YouTube. It is rock star status. Look, life is hard. Life is good, but life can be frustrating sometimes. Money doesn't have to be. The team here at Heritage Investors and Financially Simple is going to continue to make your life at least financially simple. Hey, y'all go out and make it. You got to make it. It's not going to happen unless you intentionally make it a great day. Y'all take care.